Portfolio Manager Don Huber is still in studio with us to discuss where the fund has been finding opportunities, and perhaps that's just looking at your top 10 holding. Again, I'm coming back to this geographic diversification. Anything from China in your portfolio in the top 10?
We do own a company that's actually not based in China, but has a meaningful business coming from China, from mainland China. We own a company called Hang Lung Properties, which actually is based in Hong Kong. And really they have two main lines of business. They have an inventory of high-end condominiums in China that they sell off periodically. And then the real growth is coming from developing retail shopping centers within mainland China.
And so obviously just very much aligned to being able to cater to that Chinese consumer at this stage.
Absolutely, and really benefiting from the rising living standards and an appreciation among Chinese consumers for Western brands.
But it's not an overriding theme in your global growth portfolio?
No, there really aren't overriding themes. We don't think of ourselves as thematic investors.
It's stock picking.
We're looking from the ground up for great high-quality growth stories. And in fact, we have an approach to risk management that keeps us from concentrating too much in any one area in a way that would add more risk to the portfolio. So as we think about Hang Lung Properties, for example, and think about their exposure to the Chinese consumer, then we think about any other companies that we own and their exposure to the Chinese consumer and make sure that we aren't overexposed or bringing too much risk to the portfolio.
So Don, I mean, you talked off air a little bit about this, but in the case of where you hold an Apple, you won't go and hold a Samsung or any other product that would do consumer electronics. You look for the best stock in that industry that suits the mandate that you're looking for.
Absolutely, and that's part of the initial work that we do and continue to do in the process of owning a company. So as our analyst finds a company that they think is attractive or an industry that they think is attractive, they're looking at the competitors, the peers, the customers, the suppliers, everyone in that ecosystem, and making sure that they're identifying the company that's the best fit for our strategy, recognizing that we're not going to double up on exposure with two companies.
Having said that it's not thematic, do you potentially leave out some industries which could be sunset industries? Is there anything that is a no-go from the outset?
Well, we haven't owned utilities in a long time, highly regulated business and not so attractive to growth investors, although we'd be open to them if we found them. And pretty much everywhere else we're willing to and willing to look at companies and open to looking at them. There have been some areas of the market that we have tended, the global landscape where we've tended not to find ideas or tended not to focus. Within energy, for example, we've been drawn to energy services companies. Within materials, the same thing, to more services, value-added companies, as opposed to the hard asset companies. Maybe great investments, maybe phenomenal for companies, but for us as cash flow-based investors, don't really fit our strategy.
Don, I just wanted to ask you, when we talk about these things like industries and their positions within industries and the ability to grow. How do you evaluate a management team? Because obviously many fast-growing companies can be highly acquisitive. So you're almost taking a bet that the CEO and the management team are going to make the right acquisitions at the right, not only at the right price, but obviously in the right way that would really add to the growth of the company. How do you do that when you have a smaller company that's growing quite quickly? How big is the management factor in some of the evaluations and the decisions you make?
Yep, the management factor is critical to us, and again, it kind of falls under what we think of in terms of quality. But management that has executed historically and has a demonstrated track record in doing that is important, and so you evaluate that by looking at what they've done historically, what they've told investors they were going to do, and how well they've been able to execute on their plans. You evaluate that by talking to management and understanding how they've adapted the plans as circumstances have changed and what their track record is in being able to do that. You do it by looking at the returns they're generating and look at their track record in focusing on shareholder returns as opposed to focusing on continuing to acquire companies just for the sake of getting bigger, which is not really a business model that we find is necessarily repeatable and certainly not attractive to us.
If one was to look at your portfolio, given what you've set out as your growth mandate, one could say those top 40 stocks are market leaders within each of their spaces. Would that be a fair analogy?
That's fair. They are leaders or close to the leaders in each of their categories.
I wanted to come in here and ask you about a company I've seen here on your top 10 called Schlumberger.
Mm-hmm.
I think it talks to the energy services field. You don't like to give. I guess the analogy is that you don't do mining or you don't do gas yourself, but you supply the miner with a spade. Is that the case for Schlumberger in the portfolio?
Yes, it is, and they are a U.S.-based company, but really the I think well-recognized technological leader in energy services, and with a number of great technologies that they bring forward, things like seismic mapping, showing the oil and gas industry where to drill, which is critical as more and more discoveries are offshore, given the harsh environments and the exorbitant cost of drilling offshore. You need to know where to drill. Or real-time mapping of a reservoir and knowing as you're drilling how you should be drilling and where you should be drilling to get at the resource. I think broadly speaking, what we recognize and what's led us to a number of these services companies is that the commodities are becoming more and more difficult to extract. The easiest commodities, whether it's minerals, metals, oil and gas, whether it's onshore or offshore, the easiest reserves have been tapped. And the harder, more difficult ones require a much greater technology component to do that. There's a much greater regulatory oversight now, and all of that we think plays to the benefit of a company like Schlumberger.
Just on another one that I was quite interested to see that you hold is Umicore.
Mm-hmm.
Just tell us a little bit about that company, because I think it ties into some of the problems South Africa is facing. If I understand that it's a recycler of materials, is that right?
Yes. Well, they have broadly speaking, three very attractive segments. They operate in the materials space and are really, again, a services provider. So one of their businesses is providing cathode material. They're the second largest cathode material provider for rechargeable batteries, for consumer products, with an expanding opportunity into hybrid and electric cars. The second business is recycling, an ability to take industrial output and refine that back down into a number of precious metals. That business is being driven right now by value-added recycling, where it pays to be done, or the output pays for the cost of the recycling. We think over time it will be more and more required from an environmental standpoint. They've actually just built a plant in the last couple of years to recycle electric and hybrid car batteries, because ultimately something needs to happen to those batteries, and so they are at the forefront of doing that. And then they have a third business, which is providing materials for catalytic converters. And they're, in particular, South Africa, with a large auto production, is a big customer for them.
Just in terms of, I know again, you've put out the caveat that you don't look for macroeconomic themes, but there must be discussion about the biggest risks to the story, the growth story going forward. Is there anything that you can share with us on that front in terms of a red flag across the board for you?
I think the biggest risks that we face or that we look at and think about for our companies are really company specific. What are the risks that Apple isn't able to continue to innovate? What are the risks that that a company loses its competitive advantage? So the biggest risk that we think of for every company is really company specific. From a macro standpoint, clearly we're watching the U.S. and the pace of growth in the U.S. Clearly we're watching developments in Europe and the pace of growth and the trajectory in Europe. But for a number of our companies, there's more than just a cyclical component to what they're doing. There's really a strong demand for their product sets.
Irrespective of the economic environment.
Precisely.
I think just to talk
one
about
final question. You've got
one
time
final
for?
question for Don. I think we've had him on the stand here for the whole show, so I'm sure you're ready to go. But just in terms of the companies, the technology sphere, obviously we're starved of technology companies here. We've got a few, but nothing like what's on offer in the States. Are they very difficult companies, fast growing, many of them, but are they very, very difficult for you to evaluate?
I think that the biggest challenge for technology companies, in my opinion, is retaining a competitive advantage. Technology changes so rapidly, and the ability for yesterday's products, innovative products, become today's commoditized products. And so identifying a company that has a leadership position and seeing that that's durable and sustainable over a number of years is, I think, the biggest challenge. We have found a number of them. Apple is an example. Informatica is an example where we think that competitive advantage should stay and that the secular growth behind their products is strong. But it is a challenge for us within the technology space, given the rapid development.